The new inflation data is here, and we absolutely have to talk about it. What it means for the economy, for the stock market, and for your portfolio, the most important of them all. Now, if you're in a hurry, I understand this. That's why in all of my videos, the bottom line comes first. And here it is. The inflation rate was supposed to be 3.1%. That was the estimation, the consensus. It came in at 3%, lower than expected, which is good. This means that inflation increasing, but at a slower pace than we anticipated, that the experts have thought. Now, that means that the Federal Reserve is getting better results from the market based on their interest rate policy right now, which is quite high. That means that the Federal Reserve, given these results, is now more likely to increase the pace of rate reductions and potentially move them up a little bit earlier than expected. Whether it's 2 or 3 rate cuts, we don't know yet, but there will be rate cuts in 2024 based on what just happened and based on what Jerome Powell said yesterday, which is my next point. But before I go to that, just a quick reminder, don't click nothing, don't smash nothing, and don't buy nothing. Just listen. So yesterday, in a very nonchalant manner, Jerome Powell actually blew everybody's mind. He was on TV and he literally said the opposite of everything he said so far, saying we will cut rates even before inflation drops to 2%, which is our target. Now, that is literally the opposite of what we heard from this man for the past 18 months. Now, he said it now, understandably, because he absolutely had the numbers beforehand. There's no way. I'm going to put my hand in the fire here. I'm going to tell you right now. There's absolutely no way Jerome Powell comes out yesterday and says, hey, we're going to lower rates. Even if we don't hit 2%, it's fine. We're doing it. Unless he knew the numbers beforehand. So he 100% knew that inflation was better than expected. So that's number one. Now, the other thing we learn here, and that's probably the next question you should ask yourself is, well, Tom, inflation is better than expected. Why aren't the market rallies like crazy? I mean, the expectation would be from a normal, logical person, well, if inflation is better than expected and we have more rate cuts, wouldn't the market fly up like crazy after news like this? Well, not necessarily. I'm going to explain. There's 2 things in play here, and that's why I always wait with these videos. I don't put out this video at 9 a.m. right away because I want to see how the market reacts before I give you the analysis. I don't want to rush it and just to get some quick views and not actually providing value here. So the thing here with the way the market has been behaving for the past 2 or 3 hours is this. Number one, a lot of this was already priced in. Now, I'm not saying that people outside of the Jerome Powell circle knew about this, but we had a lot of price action in the stock market leading up to this report. Before the CPI came out, we had a couple of days of the market going crazy. So either people expected this or they knew this in advance. I don't know which, it doesn't matter. But the fact of the matter is that a lot of this was already priced in the upcoming days before the CPI report. Number 2, you have to understand that the idea of rate cuts isn't in itself a magic pill that's going to send the market into the stratosphere. It's not that simple. In order for the economy and the stock market, consequently, to feel the effects of the rate cut and to fly up into the stratosphere, what needs to happen is that the Federal Reserve must cut rates, but it must do so on its own terms. Throughout history, whenever the Federal Reserve actually cut rates because they had no choice, because they were forced into it, because the economy started to break, that rate cut didn't lead to an explosion in the economy and the explosion in the stock market. When the Fed is forced into rate cuts, that's not always a good thing. But throughout history as well, whenever the Federal Reserve actually cut rates when they wanted to, when it was a prerogative, not because the economy started breaking, that actually led to an explosive reaction from the stock market and the economy. Now, you see, in this current situation, there's a lot of concern that this may be a little bit too late, because if the labor market is cooling down a lot faster than we would like it to, if consumer spending is coming down, if consumer debt is coming up, there's a genuine concern that these rate cuts might be the former situation that I described, which is where the Fed has to cut rates and the economy doesn't have these explosive reactions. So the fear here is that these rate cuts will be the precursor to a recession, which what happens when the Fed actually has to force itself to cut rates because of bad economic terms. That's not necessarily true, but this risk will have to be priced into the stock market because the stock market is a pricing mechanism of the next 6 months. So this is now part of the scheme, part of the whole setup, part of the mathematical equation. So that's also contributing to this cool down we're seeing in the markets. According to the FedWatch tool, which I think everybody here should be following, where you see the percentages, the odds of the Fed actually cutting rates, and this has been one of the most accurate ways to predict what the Fed will do. Right now, the market is pricing in 3 rate cuts in 2024, meaning September, November, December. So all we had today is just a confirmation of that 3 Fed rate cut scenario. And look, I know I'm going here against the grain a little bit, and I know mainstream media makes a living off of talking about what the Fed will do next, but at this point, it becomes slightly irrelevant. The whole ballgame has changed here, and I want to explain exactly what I mean. Now that we know, based on what Jerome Powell said yesterday, that they will cut rates, now that we know that the inflation data is coming out cooler than expected, we will likely have a rate cut in 2024. Whether it's 1, 2, or 3, doesn't matter. So the big question now turns back to macroeconomic data, away from the Fed. Now that we know rate cuts are coming, the question is how good GDP, consumer spending, and unemployment will be once the Fed starts cutting rates. If the economic data is good enough, it's not breaking, then that Fed rate cut is going to probably lead to a very positive reaction from the stock market. However, if the macroeconomic data weakens and it becomes less than optimal before the first rate cut, then that cut might not be enough to pull this out of the mud. And then the stock market might actually start pulling back. So what I will be doing for the next few months is following the macroeconomic data, unemployment numbers, GDP, consumer spending, these sort of things. The whole obsession about what Jerome Powell said and didn't say, sure, we can talk about it, but now that's no longer the focal point. I want to explain this because you're not going to hear this anywhere else. Now, as always, I do appreciate your time, and if you lasted this long in the video, I want to invite you to join our community, discord.gg/Tom Nash. It's free to join. Become a community member, join our 12,500 members. And if you would like to take the next step and become an Academy member and learn with me about DCF, about modeling, about investing, long-term strategies, everything a long-term investor is learning about, I don't give out trade alerts. I don't do none of this shit. If you want to become an actual student in our Academy, patreon.com/Tom Nash. You can try it out for 30 days, money back, no problems, no questions asked. And if you want to have your own tool to model and do DCFs and everything that is to do with long-term investing, check out stockmvp.com. It's a tool I've built for you. And now at 25% off if you use the code TOM25 for the next 24 hours. I'll see you in the next one.